Hello, everyone, and welcome to this morning's Forex session. I'm just looking at the time. Apologies for starting slightly later than anticipated. We were just making sure that everything was working here at our end, as we've had a few internet outages lately and power cuts and all sorts of things, but all seems to be working fine. Thank you for taking your time out to come and spend it with us, for this session. I know, we're always, David and I, are always very grateful that, as I said, people do take the time out to come and spend it with us. So it's lovely to have you here. But before we start, as usual, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. I've had a quick look down the list of attendees, and I can see we have some of our Forex program students, some of our quantum users, but I think we've got quite a few new people today. But this is only, I'm just going to show one slide, and basically, this is the first time you've joined us. Obviously, we're going to look at the Forex market. We don't just look at the charts, because with the Forex market, in fact, in all trading these days, you really have to go beyond just chart analysis. Obviously, chart analysis is very important, and we will be looking at the charts using our methodology of volume price analysis. And best way to explain that is when we actually see a chart, but it's made up of 5 elements: price action, volume, candles, candle patterns, support and resistance, and time. But as I said, the best way to see that is actually on a chart itself. But we also look at what's happening on the fundamental landscape, and also look at the related markets, because there are 4 main capital markets. As you know, there's Forex, there's bonds, there's commodities and equities, and they all have a relationship between each other, and they're also internal relationships. But for Forex, we're looking at how the relationships between these 4 markets, how they can impact what you actually see on the chart. And today, I suppose, has just been it's a classic example. As you know, yesterday we had the FOMC. Later on today, we have the BOE and also the ECB. So it's a pretty heavy duty day with respect to, oh, there's my little graphic about volume price analysis. And as I said, this appears on some of the other videos, but we haven't used it lately. As I said, a foundation methodology. Then we put, you add your tools on the top, your indicators. We have proprietary indicators, and it's all overarched with time. And time in this case is not just the time frame that you are trading, but also we look at things in multiple timeframes, and they are so important, multiple timeframes. We've got another session later on today where we will be, it's with the US stock market. We look at stock trading, and we've got a fantastic example of how, if you don't look at multiple time frames, it can give you a very, very distorted view sometimes of what is actually happening on the chart that you are trading. But that's for the session later on today. A very quick look. I said there are 2 main events today. One is the BOE, one is the ECB. It's all about central banks. I'm not going to look at the calendars. You've got them there yourself. I just wanted to see what was going on generally around the markets. As I said earlier, we need to know what the other markets are doing in terms of what we call sentiment. And as we can see here, there's been a very positive reaction to the FOMC yesterday. Not quite sure why, but there we are. There are a number of factors to consider, a reason for that, and I'll touch on them as we go through this session. But basically, the market has taken what Powell said yesterday. Initially, when the statement came out, if you were watching your charts, the dollar shot up. Everything, it was all a bit sort of doom and gloom. Then there was the press conference. Whether it's because he has now been reappointed as the Fed chair, and he sort of soothed, he said the right words basically to reassure the markets. And up we go. This is the Dow futures. The Nasdaq futures are also up. The S&P futures are up as well. The VIX is actually below 20. Those of you who come along to our stock trading session will know that the key level that we have mentioned for the VIX, which is the fear index, is 20. 25 was a little bit was a little bit of an atelier. 20, I kept saying 20. Watch that 20 level. If the VIX holds 20 or goes below 20, this market is still going to go up. And lo and behold, it has gone up. Now, I mentioned earlier, why did I think that, it was all a bit of a contradiction in what he said? Because if you think about it logically, so coming down the track, we have the bond buying program is going to come to an end, and interest rates are going to go up. Now, I do appreciate interest rates are at a very, very low base. I do appreciate that. So going up is relative. They're not going to go up by 4 or 5%. They are going to go up incrementally. But generally speaking, when a central bank signals this is what is going to happen in the future, markets tend to think, oh, right, okay, well, I'm going to have to prepare for that. And they have a little bit of a, they take a little bit more cautious, as it were. But no, up it goes. We will have to look at what the volume is behind the moves we are seeing at the moment. It is also happening against what we call, what we call Santa's rally. Markets like to end the year, and by the year I mean going into not the end of December, coming into the holiday Christmas time, which starts next week, on a positive note. There is also lower liquidity. A lot of positions have been closed out. So it's a very particular time for the market. So as I said, you do have these other factors. Now, it may be that once this initial sort of almost a sigh of relief, as it were, it's almost as if, the Fed have kind of got it in hand. He's kind of, Powell is saying, look, don't worry, guys. I know your fears, but we've got it in hand. They said, okay, let's continue on with this party. It's really about the kind of understanding the psychology behind what they were saying, because sometimes what they say and what they actually mean can be two different things. I don't want to make it overly complicated. All I'm saying is, call me cynical, call us cynical. We come to markets from the standpoint of that they are hugely, hugely manipulated, and words matter. Perception matters, but if you actually step back and look at it with a slightly more skeptical view, what they actually, what they propose to do next year, i.e., this nice smooth interest raising trajectory, it doesn't sit for us. It doesn't sit well. They may get, things may go as planned. The economies appear to be recovering, etc., etc. But what do they say about the best laid plans? Because markets may have, kind of discounted what's happening with the latest virus variant, and we don't think, this is David and I, we're not scientists, we're not virologists, we're not epidemiologists, but we are historians. We do know our history, and I'm talking history going back, to the last pandemics and the last plague. I think they are, the central banks are being overly optimistic that, we're coming to the tail end of what we've been going through for the last 2 years. We don't think that is the case. There is more to come, and how they then respond, we will wait and see. So as I said, it may completely blow their plan out of the water. Anyway, enough of that. I'll be writing a little bit more about it on my Facebook pages, and we will incorporate it into the various posts that we do that go up on my site. But I just want you to to understand two things. First of all all capital markets are connected, and you know, sentiment is one of the most important. By sentiment, I mean, is the market feeling risk on or risk off? Whether that risk on sentiment is driven by manipulation or not, you still have to trade what you see on your charts. And what we've seen this morning is, you know, massive buying of the Kiwi dollar and the Aussie dollar, and those two are the two currencies which are always at the forefront of whether the market is prepared to take on more risk. And it has delivered some great trades. So, you know, great. Trade what you see on the chart. Bear in mind of this, the time of year that we're in. If you get a trading opportunity, the chances are is, you know, don't stay in it too long. Come out. There will be volatility, and after today's two other central banks, the ECB and the BOE, you know, the market, everything will, you know, will dramatically, in terms of liquidity, will decrease, and certainly by next week, you know, we may look at charts, but to be honest, trade-wise, no. I think David has still got some positions open. He's got to decide whether he's going to close them out today, tomorrow, or wait until next week. And, you know, enjoy the holidays, because it's really important that we all have a rest and we take the enjoyment where we can. Right, going back to the charts at the moment, as I said, it's pretty obvious what's been going on. I'll just go to the hourly matrix and of the CSI, and also interestingly to the dollar index, which I have on my MT4 platform. I've got MT4. I think David's got, you've got Ninja, darling. You've got Ninja and TradeStation. Yep, he's got his Ninja on. Basically, a very quick look around, see what's happening. We can see here, this is the buying that we have seen, and is still buying in both the Aussie and the Kiwi. They're not really, you know, they're not terribly over extended, and but more pertinently, which I said this thing about the sentiment, the currencies will pick up the sentiment of what is going on in risk assets. What you want to see, if this consistency, you want to see the Swiss franc being sold, you want to see the dollar being sold, you want to see the Japanese yen being sold as well. Doesn't always happen. We do sometimes get divergence, and often the currencies will be saying one thing, and what you see happening on the charts in other markets will be saying something else. Does that invalidate this correlation? No, it doesn't. It sometimes means that the Forex market is actually ahead of the game. You know, traders and investors are actually positioning themselves. They say, oh yeah, there may be a bit of euphoria over there, but actually, you know, for whatever reason, it's not going to last very long. So they're kind of, as I said, you do get this positioning ahead of time, as it were. Looking at the dollar index here, what's interesting is, let me just go and look at the see if the 15-minute is still up here, or the yeah. This really encapsulates what happened with the FOMC and the two. It was like using a football analogy. It was a game of two halves, or a soccer analogy. So the first part, the markets reacted to the statement that comes in two parts, and you saw, if you were following it, obviously there was this huge rush up, as we saw here, on the indexes, you know, a lot of dollar buying. But look what happened. We had a trigger of the volatility indicator. This is an indicator that triggers in real time, and it's when the price action is outside of the average true range. This was clearly outside of the average range, and the dollar was reacting exactly as you would expect. You know, there was concern about, you know, there was going to be tapering in interest rates, you know, and it also carried on from various statements that were kind of made a couple of weeks ago. One thing you have to do as a trader is, if the dollar, for example, that if you trade a particular currency more than others in its various pairs, so for example, if you do the majors, you really have to get to grips with whenever what the central bank is saying, the individual members are saying, and also what they mean. It does take time, and watch the market reaction and think, aha, and kind of note it down. You have to kind of do profile them. You know when police do profiling on killers and what have you. That's what you have to do. You have to do kind of profiling on the bank and on the individual members, because the markets, so is everyone else. It's down to the psychology, and the markets will react accordingly. And they all have a way of speaking. They have the market will pick up on particular terms, on particular phrases, and as I said, will react. And one of the words that the markets were that Powell had used earlier on in the year was this word transitory about inflation. I think I saw a chart recently where I think pointing out the number of times that particular word had been used in the previous month, and you can see there was a falling off. So clearly, they were becoming concerned about inflation. Anyway, the first part, shot up, volatility triggered. Usually with, in fact, this applies to all major fundamental releases, is you often get, this is what we call the knee-jerk reaction. And it was a classic one, shot up, volatility triggered, it almost came back almost down immediately. But most importantly, the next candle was also a volatility candle, but it was within the spread of this candle. So it was, the market was just racking about, no real idea what was happening. Then we had another volatility candle again within the spread of the original one. And what happens is, talking about support and resistance, is the importance of these volatility candles, not just that they tell us that momentum has come into the market, the volatility has come into the market, but the high and the low of these candles then give us some pointers as to whether, if it's going to break to the upside, it's obviously got to clear that, and obviously to the downside as well. Now, what's also interesting, there was a ton of volume under this one, but then there was a big wick to the bottom at the top of the candle, so I knew that there was weakness coming in. But also the next candle, which is obviously not quite as much, but there was substantially less volume under that one. So that kind of tells you, that's maybe this is just the usual spoofing that goes on, a knee-jerk reaction that you get on the release of these on these releases. Then we get the next one, another volatility candle, and then I think then you move to the statement and what have you, and then you get the Powell the words coming in and down and down. Now you do see a falling off of the volume, but then you do have to bear in mind the markets, the US session was coming to a close, and which is why you do have to read. This tells you that the move is coming to an end, the volume is falling, and also read it in conjunction with the relative, in the context of the session, as it were. So going back to the daily chart, where are we at the moment? This is encapsulated on the candle of the day. Obviously the rush up higher, then the fallback, and now it's moving lower once again, because we can see the dollar acts both as a safe haven, as a risk currency as well. What's also interesting on the daily chart is these two up candles from a couple of days ago. I actually said to David, I said, they considering the, I know it's time of year and what have you, but they kind of looked a bit sort of okay, and obviously with the Fed coming along, but to me, they didn't look as though there was a lot of conviction behind the move higher in the dollar. And in fact, it's been sort of around the sort of moving in this sort of piano key, down, up, down, up, up, down. It's great for intraday trading. There have been lots of opportunities on the faster time frame, and also this key level here. These levels are derived, this is from our Camarilla indicator, and I think we've done ourselves a bit of a disservice, because perhaps what we should have said, they are in, strictly speaking, Camarilla pivot points because it is derived from the old-fashioned floor pivots, which is why they work so well, particularly the third and the fourth levels. We've developed it with 6 levels, and we've put a couple of other little bits and pieces in there as well. But the third level is so important, and very, very often you will see prices actually aim for that level. Sometimes, most often pause, sometimes congest, and then it will. Sometimes it reverses, and sometimes it will carry on. But they're very important levels to have on your chart, because, as I said, not only do they offer a target, if you like, you can be used for stop losses, but they also, they can be also a springboard, if you like, for the next part of the move, whether that's going to be a reversal, a pullback, or reversal, or actually a continuation. But you do very often get a significant pause at that particular level. The way they work is on the time frames, from the fastest time frame through to, but not including the hour. They are recalculated every day, and from the hour up to the day, they are once a week. So these are in play for the rest of the week, and then on the weekly chart they are in play for the rest of the month. So it gives you this three-dimensional picture of what's happening in terms of levels. Now, the actual pairs that I looked at this morning, with the what to trade going into an important release such as the BOE and the ECB, and this is just a suggestion, is why not? Stuff's always moving, but this is for intraday. If you holding, I would. It's up to you, and it depends how many contracts you have. So if you take, if you get a nice move, I mean, let's have a look at. I've been looking at 2 today: pound Aussie and actually Aussie dollar. And it's been, so another interesting aspect today about the pound is it hasn't really wasn't doing very much against the US dollar. It wasn't doing very much when I first looked at it, and it was going in the same direction as the Aussie on the CSI. When the two lines move in parallel, as this is here, for example, you've got the Aussie Canadian. What that often tells you is that there's obviously no clear divergence, because what we want for a really nice move is nice clear divergence, and it's just not going, they're just not moving very fast. So what you want is clear divergence, and there's been very clear divergence on the Aussie dollar. This is just the 15-minute chart, and those of you who've been looking at Aussie dollar, I don't know if David's going to look at Aussie dollar, I'll leave that one to him. You've had strong buying of the Aussie, strong selling of the dollar, and that's great. But at an earlier point today, the Aussie and the pound were moving. The pound wasn't doing anything, but the Aussie was motoring really, really strongly. And it's often worth going to see what is happening on such a pair, because, if you like, although it's an asymmetric move in the sense that there's a stronger force in one direction, it's not a nice, even in terms of divergence, it can often produce a really, really, really nice move, and in fact it has on the Aussie dollar, on the pound Aussie. And this is the section of price action that I've actually been looking at, and what often happens is that it's being driven in one direction by one of the currencies, and then as that currency, this case the Aussie, keeps pushing forward, as it were, as it has been, the second currency, in which case the pound, then turns, it moves away from this kind of almost parallel, and then you get you get a more equal driver. And this is really what has happened on this particular pair. Going back here, we can look at the R3. I know we had it it poked through and then it came back again. But you can see here it touched it again here, didn't quite get here. You've got lower highs, sort of kind of lower highs as you go to that one, to that one. We did get a little bit of a down, a pullback. It did have a little minor attempt to rally there, but this is the move that I've been looking at primarily off the R2. I'm just using the Renko because the Renko shows you the price action in a very geometric way. So it takes away all the, if you like, all the noise that of the time chart. And we can see here you have wicks, you have it's just, as I said, it's a more noisy chart. We do need wicks. We do need to see the wicks. And what we say to our traders is use the time chart in conjunction with what you see on the Renko. They complement each other. And if we want to see, going back to this 5-minute chart here, well, what is the 5-minute chart telling us? Well, for a start, you can see there's tons of volume going into this pair, but we look at the time, we take off 2 hours, it's clear. This is what I mean by context. It pushes all the volume from the previous Asia Pacific session down. These are not recalculated, but they're presented in a in a different way. It doesn't invalidate the volume that we saw coming through on the Asia Pacific session, but with London and Europe coming on board, this is where the bulk of the business is done in Forex. It's done in London, Europe, and then partly in New York. It's the deepest liquidity. But to look at these charts, most of us, certainly I down here this morning at around when the London session is open, we can see this move higher. Just looking at candles, what do we have here? Well, we have a nice sort of shooting star candle. We see here this failure at this R3 that we also saw on the Renko. It didn't actually get there, but it doesn't matter. But we have a strong candle, the shooting star candle, a ton of volume underneath it. That of itself tells us, well, it is going to come. We are seeing some weakness here. We don't have volatility with the cross pound pairs. The nice thing is, unlike the majors and the pound yen at the London Open, this would be around the London Open about 8:15. You don't get that. You don't get quite so much sort of kind of racking about, as it were. So we know that's on a looking to potentially reverse. As I said, tons of volume underneath it. You say, well, if you look at the volume and you look at this pullback on these candles, and you think, well, hold on, that would be a reversal. Well, no, because the thing about VPA is you have volume, but you also have to look at kind of the spread of the candles. They're very compressed for the amount of volume that's underneath. So that tells you that if that was genuinely going to reverse, they would have to be much wider than they are. And fortunately, we do have what we call benchmark candles, because we look at this candle and we look at the volume underneath it, and you look at that volume and you look at that candle and you think, they don't it's an anomaly. That's what I'm trying to say. So yes, there's it's desperate trying to go higher, a lot of effort going in, but not the result. And the result you would expect to see was a candle of that range as well, or even that range. It's not. So that tells us this is this signal that we first saw based on the shooting star candle is possibly valid, as it were. One signal, that's all it is, and we just have to be a little bit sort of patient to see whether it plays out. But this was certainly 2 really nice candles. You think, yeah, that is actually validating what is going on there. And then the move starts to go lower. In fact, it gets to the volume point of control, where we kind of have a little pause, and then we get, if you look at the up candles in this move lower and you see what size are there, how much volume is going underneath them, and this one in particular is so compressed. given what's going in there. There is, you know, I'm not saying there's not a desperate attempt to keep this price from falling. There is. I mean, they're desperately trying to push it higher, but it ain't going anywhere. It's almost like a car, you know, trying to move uphill, and the wheels are spinning, but it isn't going. You know, it's just not going any higher. And you know, we've had, as I said, we've had this really nice move lower. Again, another attempt to rally. Look at the candle, you know, compare it with the volumes that you see beneath it. Is it consistent or is it not consistent? And it's trying to base at the S2. We did have some volume support coming in. This is from the volume point of control, but it's actually broken through. And the next question is, well, where is it going? Remember I said about the third levels? Well, here we are. Let's see what happens on the third level. So as I said, the pound Aussie is just, you know, when it moves, it will move in a really nice sort of steady way. I'm not saying it's never volatile, but what I'm saying is if you do trade British pound and you like to trade cable, fine. But do think of incorporating one of the cross pairs, and the pound Aussie, I think, of all of them is personally one of the ones that I would suggest that you look at, simply because, well, one reason is the Aussie, it's such a strong currency, and it's so and it's, you know, particularly when it comes to sentiment, and as I said, it can deliver some really nice trades. Right, what's happening here? Well, the pound is now, you know, selling off quite strongly. It's actually the weakest pair on the pound matrix that we've highlighted here on the matrix. The nice thing about the matrix is you can sort of pick off the individual currencies and see how they're performing in what we call their matrix. So the pound Aussie is the weakest, followed shortly, you know, quite a big difference between that and the New Zealand. The New Zealand, there's been great moves in the New Zealand as well. But I wanted to pick the pound because we've got the BOE coming up, obviously, and you know, this has been such a nice move. Would you stay in it throughout? Personally, no, because you know, anything can happen. But if you're on with multiple contracts and you're in profit, take some off. Maybe you just want to leave one on for speculation and think, yeah, if it works out, it works out. If it doesn't, it doesn't. You just, you know, you let the market decide, as it were. But here we are. We're coming, as I said, to the S3. Now, what's happening with the Renko? The Renko is brilliant because it kind of absorbs all the choppiness and the whipsawing that you can see on the time chart, and it's still, where's it pointing to? Well, it's certainly, this is the key level that we would be looking at. Now, as I said, I'm not going to do the Aussie dollar. I think David might be looking at that. Where are we? Is that ready for a turn? Quickly look what the Aussie pair's doing. Here we are. So let's look at the dollar pairs. They're all over the place, actually, the majors, to be honest. It's so partly with euro dollar and pound dollar. I'm not surprised, given that you've got two of the, you know, both central banks are going to be reporting today. So the action in the dollar has pretty much been in the other, well, certainly in the New Zealand dollar and the Aussie dollar. Right. I'm going to leave it there with my pound Aussie. Let's see what happens and whether the S3 actually does what it's what I think it's going to do. And I'll pass you over to David.
Hi everyone, good to have you here, and nice to see you all. Hopefully you can see my screen. Hopefully you can hear me. But Anna's taking her headsets off, so I'm not sure. But she's just checking. Can you hear me? Yeah, great stuff. Okay, fantastic. I've got the three platforms here. I've got TradingView, I've got NinjaTrader, which is up in front of you, and I've got Tradestation down here at the bottom. Where to start? There's a lot going on. This is actually the majors matrix. Very simple. This is on spot, but you could have this on futures as well. So basically, I've got cable, dollar CAD, Aussie dollar at the top there, and down at the bottom, I have got euro dollar on this one, dollar Swiss, and New Zealand dollar. I've got dollar yen on here. So it basically gives you a straight through view of what is going on. It's a nice complex to have. I've also got a yen complex over on Tradestation, but it's you can set these up in any which way you like. And really what this does is it mirrors what is going on, if you like, in terms of the currency matrix, because what you're looking at is the universal flow of that particular currency that you're trading across that particular complex of pairs. So this is cable. And where are we? This was 8 o'clock. So this is London getting underway, as you would expect. The volumes have increased quite dramatically. But then as we get to the top of that particular rally, you start to see the signs of weakness coming in. You start to see the highest volume here on an up candle, certainly since well overnight Far East into London as well. This was the greatest volume under that particular candle. In other words, we've got effort going in, but we're not seeing a result from that effort. So volume is being driven in and the price is not reflecting that. So there has to be a decent amount of selling in there. The analogy I've used many, many times before, and I'm sure you've heard it, is of if you imagine driving a car up a mountainside in the middle of winter, the road is icy, maybe it's got snow on it. And as the incline steepens, then you apply yet more pressure to the accelerator of the gas. And at some point, the wheels will be spinning so much, you'll actually come to a full stop. In other words, you're putting so much effort in, but you're not actually moving forward. And it's exactly the same principle here. It's Wyckoff. There's a very basic Wyckoff. There's a lot of effort going in, but that candle, if that candle were truly reflective of this volume, and a lot of it comes back to benchmarking. We talk a lot about benchmarking on the program and also in the posts and what have you. It's a case of looking at what you should expect to see as a result of the volume that has gone in. And clearly, this is anomalous. This candle should be up here somewhere, probably even higher than that, given all things being equal. We then continue on and we then start to get further signs of weakness. Another little up thrust here on decent volume. Another one follows it through here. We're down onto the volume point of control. We're building in congestion. I don't know what level this VPOT was at that particular point. It could have been lower down the chart, but we're certainly building volume here now into congestion where volume and price are in agreement. A two-bar reversal at the end here. Overlay that one on this one, and what do you get? You get something similar to this one with a wick to the upper body and a pretty narrow body itself. And then we started to roll over. Excuse me one moment. Sorry about that. And then we get this little price waterfall on rising volume, but this is all against the context of how long we've got to go, an hour and a quarter or so to London Open. And the chances are from now on until then, this market, this particular pair is going to move into congestion. It's going to wait, be patient, and wait for the news to come out. And as far as I have seen, certainly on Forex Factor at any rate, they're not suggesting a rate increase. They are simply forecasting a repeat of the voting last time around, which was 7-2 against. It will be interesting to see if that changes. That will be reflected in the price action. If it changes dramatically, it certainly will, but if it stays the same equally, that too will be reflected as well. As I say, on Forex Factor at the moment, they are suggesting that rates are going to remain on hold. And to be honest, no great surprise given what we're seeing in terms of the latest variant of COVID, which may not be as deadly as the last bout, but certainly in terms of numbers, it's certainly dramatic, to put it that way. That's what's going on in terms of cable. And in terms of over on the CSI, in fact, if I pull up Tradestation, I've got them here. This is on 1 minute, this is on 3 minute, this is on 5, and this is on 15. So a gamut across the faster time frames. And that's basically what's happening. So we've seen the rise in the dollar. We've seen that reverse a little bit. You can see it here, the red line. got down here into very heavily oversold, and then we've seen some buying coming in. Exactly the same thing on the 5-minute time frame, and over on the 15-minute time frame, just starting to creep out of oversold and move higher. And as Anna said, what we're seeing this morning is typically, as I use the word cautiously, but it is what you would like to see, because when the dollar and the yen and the Swiss franc, this green line, are moving in generally the same direction, what that signals is that the sentiment in the market is pretty much 100% in one direction. In other words, there's no diverse movements in terms of other currencies, because the Swiss franc is obviously a risk currency, and if the Swiss franc is being sold along with the yen, along with the dollar, then it's generally indicative of a risk-on environment as opposed to risk-off. Yes, of course, you get divergence. You'll get the Swiss franc being bought or sold against the others when the others are moving in opposition. That's just part and parcel. But when you see this sort of arrangement, it's not perfect. Certainly the dollar and the yen are very close housemates at the moment. But when you see this sort of pattern arriving, it gives you yet more confidence that this is how the market is feeling at the moment. Certainly in terms of the faster time frames, it doesn't mean it's going to stay that way for the next hour or for the rest of the day. It just means right now, that is the sentiment that is prevailing. But as I say, all things being equal, that will almost certainly change later in the day once we get the interest rates coming through as well. And then up at the top here, we've seen strong buying in New Zealand, strong buying in Aussie, and strong buying in Canadian. Again, that tends to be symptomatic of strength towards a particular sentiment, whether it's risk on or risk off, because you have the three commodity currencies moving pretty much in lockstep together. Again, it doesn't always happen, but when you see it, it's a nice, again, it gives you a nice comfort factor that what you're doing, you are trading with the broad sentiment of risk. Just to go back onto the previous workspace, which is this one, and basically what I've got set up here is up here we have the 28 pairs, so it's very easy to scroll through very quickly because these are all time interval linked, index, instrument links, couldn't think of the word. These are all a symbol linked over here, so you can see this little S here. That means they're all symbol linked, and you've got the same sort of functionality on NinjaTrader. So you can very quickly whiz through these, pull them up, see what's going on in terms of that particular time frame. So you've got the 1, 3, 5, and 10 here, so you get a really quick snapshot. It's nice and easy. And in addition to that, on radar screen, which is this panel here and also the one below, we've got a couple of the indicators listed. We've got the quantum volatility indicator here, and it gives us an instant heads up as to when was the most recent appearance of the indicator. We're on Aussie dollar here. When was the last one? Let's go and find one more recent. Let's scroll down so we can find one. Let's go to Aussie Swiss, for example. This is on 5-minute, 29, so it's over here. We've got Euro Swiss, we've got one coming in on Euro Swiss on 5. So we can see it here, and it just gives you that instant, just pop that up full size. There we go. So let's pull that down a little bit, lost the top of it, there we are. Just move the chat box out of the way as well. So it just tells you instantly that we've got a volatility trigger on the 5-minute time frame for this particular currency pair. Is it of interest? If we're trading it, it might be, it might not be, maybe an opportunity to reverse. If we're looking at those sorts of opportunities, if we're in a trade and we're looking at possible congestion, then we want to close out, take a profit off the table, etc., etc. But it just gives you that very, very quick visual guide to see it instantly when you're looking at all your monitoring 28 pairs. Monitoring 28 pairs in multiple time frames is hard enough, but this becomes even more key when you move to the stock world, where you're dealing with thousands, if not tens of thousands of instruments. You're trying to monitor them, you're trying to filter and all the rest of it. So it's hard enough in Forex. It's extremely difficult in the stock world, and certainly tools like this, like the radar screen, what we're doing in NinjaTrader at the moment, developing Market Analyzer, where you can very quickly scan through hundreds and hundreds of charts to find those opportunities. As I say, the fact we've got one here that may or may not be of interest. If we go down to dollar Swiss, for example, pull that up. We had one 12 bars ago on 5 minutes. Just pop that up. There we go. And there it is. And you know, that may have, at the time may have been an interest, may have not been, but it's a very, very rapid way of sorting through. And then down the bottom here, I've also got the trend monitor up here as well. So when you add the trend monitor on there, what that also gives you is it tells you what's going on in terms of the trend monitor. Is it blue throughout? Are we seeing, what are we seeing across the matrix? As you can see here, again, there is some variation. We've got some red here, we've got blue, and we've got darker blue. So we've got a combination of a variety here, really telling us that at the moment, things are perhaps changing. We're starting to see this yen being bought. This is on 4 minute up here, so the yen is starting to be bought. And in fact, if I pull over, let's just drop that out of the way, go back to the charts here. This is what's happening on euro dollar. So we've got euro falling quite strongly, breaking away from a volume point of control, which is nice, coming down to potentially some low volume nodes here. But bear in mind again that we've got an interest rate in coming up reasonably short term. If I just go over onto TradingView, just to change platforms again, this is the currency matrix and this is the array. And one of the things that I know I've shown this before, but this feature is really very helpful in that it gives you a guide to these numbers here. We often get asked, what do these numbers mean? Are they of significance? They're not of significance per se, because we had to come up with a way of actually calculating the mathematics behind to actually arrive at the ranking ladder, if you will. Where they are significant is in terms of how far they are from the median, in other words, 0. So how far away are we? But more importantly, when we start to get up to these levels, what do they actually mean? Does 11.49 mean anything on its own? In terms of that, no. What it does mean when you look alongside here is we've got an all-time high and an average high. So what this now gives you, in a sense, in exactly the same way as you've got on the currency strength indicator, where you have overbought and oversold levels, which give you a sense of whether a currency is at or approaching one of those regions. This works in exactly the same way for currency pairs. So we only have to glance at this to realize that the all-time high is 21.95. We're currently at 12.89. So in terms of how much further we've got to go with this particular move, if you will, there is certainly an opportunity. Now, the other thing about the, and bear in mind, this is being added, we are actually adding this into NinjaTrader. We're working backwards. It's on TradingView, it's on TradeStation. We've got to add it to NinjaTrader. It's basically what we're doing at the moment. We are working backwards from upstream. We're coming downstream, if you like, in terms of platform. So all these features will be added. And if you have this indicator, you'll get all the upgrades free of charge anyway. It's the way we work with everything we do. But the other point I just wanted to make while I'm here, is if I click on settings, if you look at the look back period for the matrix, it's 7. And if I go over here onto the array and I do the same thing and I click on here, the look back period on the array is 80. These are two very different animals. They are looking at price action. One is looking very close up to the price action, which is the currency matrix. And the other, the currency array on the right-hand side, is taking a much longer view because it's looking at it over a longer term time horizon. So you use the two in combination. If you're a scalper, you can either use the two in combination, whether you're a scalper or not, because what both of them reveal is obviously broad sentiment across the complex for the particular pair or the particular currency you're trading. But the currency matrix is much more akin to scalping. Currency array is much more akin to trend or swing trading. And you can think of them in exactly the same way as you do with the trends indicator and the trend monitor indicator. The trends indicator works very close to the price action. The trend monitor indicator takes a step back from that price action and takes a more considered view. So the trends indicator will always signal changes much more quickly because it works close to the price action. The trend monitor, on the other hand, will change much more slowly and is there to help to keep you in. And in a similar way, you can look at the currency array and the currency matrix from that perspective as well. This is what's been going on in the market so far this morning. Top left is the pound index. These are all on 5 minute. Top right is the yen index. Bottom left is the dollar index, and bottom right is the euro. You can see the euro starting to break down now. Whether you propose to trade that with just over, well, a little bit more to go to the euro, to the ECB, possibly more than that. These are the decisions you have to take. If you're an intraday trader, you have to decide how close you're going to get to these big lumps of news. If you're trading longer term, then Anna said I've got positions on, I've got bits and pieces all over the place. Am I bothered about these releases? Not particularly, because I have wide stops. I'm in it for a longer haul. I'm not really interested in what's going on a 5 minute chart, or indeed, you know, what the news is going to be later on, because as I say, I'm in it longer term. In terms of as I say, this is the pound. We had that rally, we saw the weakness. Now we're just going to see congestion, sideways building almost certainly. This is the yen, strong selling of the yen, starting to bottom out a little bit now. This is the dollar, starting to see that dollar buying coming in, starting to see a reversal rally coming in, which is what we saw over on the multiple CSIs over here. Just flick over here, just starting to see that develop now. This is the pattern that you will see whatever aspects of trading you are undertaking, whether you're looking at multiple screens in terms of indicators, whether you're looking at multiple screens in terms of charts, it will always, any change, major change in trend will always take hold in the fastest time frame, whether that's a 15-second chart or a 15-minute chart makes no difference. And it's precisely what you're seeing here. We saw the dollar bottom out, it's starting to buy here, buying. It's flopping around a bit on 1 minute, but on 3 minutes it's more solid. We're now seeing that reflected on 5 minute, and that is filtering its way through onto 15-minute. New Zealand yen, on the other hand, hasn't started to roll. So if you're looking at this as a selling opportunity on New Zealand dollar or New Zealand yen, it's a bit early. But in terms of trading reversals, you have to be patient, because when currencies get up to these overbought or oversold regions, there's absolutely no guarantee. The dollar in this case has actually reversed quite quickly. Once it got down here, it's reversed quite quickly. The same here, but that's not always the case. Up here, for example, they are flip-flopping around. And if you're trading reversals, and I do it all the time, you have to be patient. There's two things you've got to have. First of all, you've got to be patient. And secondly, you're going to have to accept that you've got to put more risk on the table. You cannot put a 5-pip stop loss on trading reversals. It's utterly pointless. You will get stopped out almost for sure. As an intraday trader, I'm talking as a scalping trader, you've got to put bigger stop loss positions in place to allow for this buffering, to allow for the fact that these currency pairs may stay up here for some time, and they will oscillate around, they will go into congestion. It's very unusual that you see V-shaped reversals. We see it from time to time. We see it on daily charts with indices and what have you, but it's very unusual. And generally what happens is you'll see a rally, the market will congest, and then it will roll. Equally at the bottom, you'll see a fall, you'll see a price waterfall, congestions, buying volume, whatever, into congestion, and then on up the other way. That is just the way the markets behave. So if you're going to trade reversals, those are the two things you have to be. You've got to be patient, and you've got to set a higher stop loss, a much wider stop loss. And in putting bigger risk on the table, everything in trading is about risk and reward. If you put a bigger risk on the table, you should expect a larger reward, and you will get it. You're not guaranteed it, but if it does reverse, then the benefit to you is you're in early on the trade. You've got in up here. People down here who are jumping on the trend once it's underway, they've given up all this. That's the price they pay, but their risk on the table is much lower. They will be jumping in with 3, 4, 5, 6 pip stop losses. You've gone in with maybe 20 or 30. So, you know, don't cry over spilt milk. As far as they're concerned, as far as you're concerned, you're happy because you got in early. But there's always a price to pay. It's as simple as that. Let's just move that back out of the way and go back on to, there we go. Let's see what's going on here. Let's just go over onto, let's go on to the multiple, where are we? Here we are, currency pairs, multiple time frames. Let's drop that out of the way. There we go. I've got the New Zealand dollar here for that particular reason, just to really reinforce the point. This is where we are. This is on 15 minute. And what this also shows is, and it is fairly self-explanatory, but it also shows several other facets of what went on last night, that the dramatic increase in volume that comes in when you get one of these big announcements or big fundamental releases or whatever it may be, huge amount of volume coming in. And obviously what that does is it tends to distort all this. It doesn't make it unworkable. I mean, if I do that and pull all of that out of the way, huge, great candles, there we go. You've now removed that from your chart and you're now looking at, and remember what we're always doing in any volume analysis, we are comparing like with like, we're comparing apples with apples. So the volume we can compare in this session is across here, because from here to here is obviously the European session, and what we're looking at is just comparing what is going on right now. There is a little bit of weakness coming into this. There are no defining signals here that this is going to reverse. So in terms of, as I say, taking a reversal position, you've got to accept the fact that we're going to see congestion here for some time, bearing in mind what we've got going on in the background in terms of fundamental, in terms of fundamental news releases, etc., etc. All we're seeing in terms of this particular rally, just in the context of this particular pair, is that we are seeing volume falling away. So we see volume rising going into it. This is 8 o'clock London time, so the market getting underway. We see volume rising. And then gradually, as the market is increasing and rising, we'll see volume falling away. The nice aspect to this particular trade would have been this low volume region here. As we get to it, what you expect as a trader, you expect to see the market go through there pretty rapidly, because support and resistance works in the same way, whether you're looking at it from the context of these levels here, which are very minor. This is on the accumulation distribution indicator. These are very minor levels. They're very weak, in other words, because the lines are thin, but they are nevertheless price-based support and resistance regions. The volume point of control, two aspects to it. Obviously, you've got the VPOC itself, but you've also got the fact that you have this histogram which overlays the price action. So as price approaches these low volume regions, what you expect to see is the price to move through there relatively quickly, because there is very little in the way of volume to act as resistance to that price action. In other words, there's no congested volume, there aren't pending orders there. And the other slightly nuanced aspect to it, which is a little bit more of a conversational piece, if you will, is that if the market didn't consider this region to be important in the past, why would it consider it to be important now? That's a more semantic point, if you will, but essentially that is the principle. And in addition to that, when you get to these low volume areas, what you expect to see is it will take less effort, going back to how much effort we were talking about, where there's a lot of effort going and no result. When you get to those regions on the chart, I'll just pull that back to full size, there we are. When you get to those regions on the chart, you expect the price action to move through there. It will require less effort to move through those areas. And the same, of course, is true when you get a very strong price levels built as well on the accumulation distribution indicator. You also expect the same thing. When it gets to very strong levels, you need to see more volume to push through it. When it gets to less strong levels, then there's less volume required as well. Let's just go back onto TradingView for a minute, I think. Let's just go over here. That's just, this was, just to highlight this on TradingView, some of you may not have seen this. This was something we developed on TradingView, going back to what I was saying about scanning the markets. This was the maximum we could get. I think we've got a maximum of 10 on here. This was developed for the indicators, so you can actually have the indicators loaded up here. We've got the trend monitor here, and we've got the trends and the trend dot. Just gives you a very visual perspective. This is on cryptocurrency markets. We've got the cryptocurrency strength indicator here, and this works. The principles of this are identical to the currency strength indicator. The difference here is that you're actually looking at pairs, if you will, because we've got Litecoin, we've got Bitcoin. So this is actually the cryptocurrency itself, but what it's matched against is the dollar, if you like, in terms of tether, because all of these are based against the dollar, and we've split out tether here. So you get this really nice representation of what is going on across the cryptocurrency market. Now, the one primary difference between the cryptocurrency market and the currency markets, other than the various, as you would expect, in terms of price movement, is that generally speaking, almost always the cryptocurrencies, as you see here, will move en bloc. It's very unusual, it's very rare to see one cryptocurrency break away from the others and move with any degree of strength or weakness counter to what is going on broadly across the market. So in terms of trading cryptocurrencies, and then let's face it, they're all available on all the MT4 platforms, pretty much, and MT5 now pretty widely available everywhere. And of course, you can trade cryptocurrency futures as well. Is that the sentiment, if you like, is always the same across the complex. So when you're looking at a cryptocurrency market, generally speaking, all the cryptocurrency pairs will be rising together or falling together. The only differentiating factor is tether, which is down here, and it's just a really neat visual way. And of course, you can trade these across all time frames. This is on 5 minute, but it's been really popular, the cryptocurrency strength meter. In that context, go back to there. We've got over here, same, sorry, been on that one. I think that's about it here. Right, let me just pull that out of the way. Just go back to our New Zealand dollar, still flip-flopping around. And the other aspect to trading reversals, just picking up on the reversal trading point, the dollar might travel all the way up here, and the New Zealand dollar may well stay there for the rest of the session. There is never any guarantee that this is going to roll, and it's a question of picking those pairs which are going to move and move in opposition, because what you want to see is pairs which are moving diametrically opposed. So for example, I don't even need to look at a chart right now. This is the CAD. So if I had the Euro CAD up right now, I know I've got heavy selling on the Euro and I've got strong buying on the Euro on the CAD. So I know for a fact on these faster time frames, it's a really nice little run going in terms of to the downside in terms of Euro CAD, selling of Euro, buying of Canadian. If I was to look at Euro Swiss, for example, not a lot going on probably. If I was to look at Euro dollar, yeah, there is something going on because the dollar's rising, Euro's falling. If I was to look at Aussie, New Zealand, not much going on, and so on and so forth. It's the beauty of the currency strength indicator. It tells you so much. It tells you which pairs to go and look at, which pairs not to bother with for the time being. It tells you the strength by virtue of the inclination of the line. How steep is the line? If it's very steep, you're seeing strong buying, strong selling. If it's pretty weak, over here, for example, we've got New Zealand flip-flopping around. That's basically what we're seeing over here. It's going sideways. So you wouldn't go and look at that. You're constantly teasing out, looking for those opportunities. And as a trend gets underway, if you're a reversal trader, terrific, you get in early. If you're looking at jumping on a trend, then what you're looking for is a crossing position. Looking for those points at which a currency is moving lower and others moving higher. You're jumping on a moving train, you put a tight stop loss on, and you're underway and you're in the trend. You haven't jumped in early, you haven't got in here, so you've lost all this, but you are jumping on a trend that's moving with a lower risk opportunity because you've had to put lower risk on the table as opposed to someone who's got in early and put a higher risk on the table. Yeah, I'm just going to pass back to Anna. Hold on.
Hi, I just wanted to ask David to switch over because just to have a look at the pound Aussie, and we've got this, as I said, this key level that we have here, and we've had one sort of bounce off it, and we're back down to testing it again. But this is what I was trying to explain, that when you come to these important levels, often you will have a pause, you will have a you will have a bounce as well. And look at the candles, look at again at, and you think, well, is that going to hold or and possibly reverse, or is it going to carry on lower? You just look at what the price action's been doing, the candles have been doing, the volume has been doing. Clearly there is, it's an important level. Because it's the S3 anyway. You also have to remember the way the institutions trade this market. There will be buy orders, there will be sell orders, there'll be a raft of at all sorts of points, on the scale of price. Zeros and fives are always very, very important. Sometimes they coincide, as I said, with volume levels, price-based levels. Whether that actually happens, as I said, is hidden within what you see in the candles and the volume, and it's these anomalies all the time. So when you see a lot of volume coming in and the candle doesn't respond, the price range doesn't respond, it's not consistent, then that tells you, do you know what? Yes, it may hit it again. Because the other thing with levels, and this applies especially with Fibonacci levels as well, and even moving average, when they come to a level, is there is an automatic assumption, oh, it's hit an important level, therefore it must reverse. It doesn't always happen. Statistically, maybe it does more often than not, because traders don't tend to look at the volume with the candles and see, is it actually telling you that there's going to be a reversal there? There's obviously been huge amount of effort going in at this particular price level, but at the moment it doesn't seem to be sufficient. It's trying to get through. It's going to need just as much volume to go down. There's going to be a lot of selling coming in. It's almost desperately trying to claw on. But if you were going to simply take it as, oh, well, it's reached this important level, I know it does it before, right, I'm just going to go long. You've actually got a little 2-bar reversal here. But when you look at 2-bar reversals, look at the volume on the second candle. There's down volume, there's obviously, selling there, but that, you want to see at least as much or perhaps more to show that there's a bit of conviction behind it. I'm not seeing the conviction at the moment. Then I look at the Renko. What the Renko is very good at is keeping you in. It's saying, yeah, we know it's at this important level, but just nothing there at the moment. I've got the 15-minute CSI. I've got the pound still falling. Yeah, the Aussie might start to flatten out and reverse, but remember what I said about this asymmetric move. They can happen. You do get an overshoot on these key levels. Would you be looking to say maybe add to a position, or if you've missed it to go in? I would wait a few candles, because as I said, just as it happens on the one side of the level, it can happen on the other. In other words, it will push through, but then it will reverse back. And now what we want to see is what's happening with the down candles. Are they now inconsistent with what you're seeing underneath the volume? And you benchmark, you think, oh right, well that's as much volume under that one, and that moved, but this one didn't. These are the kind of conversations you have in your head. And what they also do is they take away the emotional sting that you can suffer when you've got money on the line in the market. What's also interesting here is the volume support is breaking down all the time. The VPOC is a dynamic indicator. So as these levels are placed, as the price-based levels, they're not fixed. The only fixed ones are the Camarilla pivots. That's it. I mean, those are the values for today, basically. So it's really, really, interesting. And as I said, the pound is, you can go down a time frame, go down to the 5-minute chart. Where is it? Well, yeah, you can see the Aussie is rolling, but there's still some downward pressure on the British pound, which is clearly driving, you know, this pair, even though we can see the Aussie turning over. It's, as I said, fascinating to watch. Now, what also gives us the, you know, perhaps this has got a little bit further to go, and that is we've got nothing on the slower time frames. Excuse me about that. I've almost finished anyway, and I'll pass back to David. You know, if this is going to go lower, well, we've only got the S3 down here, but interesting. And you know, do this yourselves, even if you're not in a particular trade. Just watch it like this. You know, implement the VPA concepts, and you know, and you will soon be able to start spotting, as I said, these anomalies. And in spotting the anomalies, you will then, you kind of, it helps you anticipate what is likely to happen next. Right, I'm going to say goodbye. This is the last session of this year. Can I wish you all a wonderful Christmas with your family and friends. You know, it's horrible out there at the moment. I took a call earlier on from someone and I said the world feels as though, you know, it's having a psychotic breakdown. You know, just stick to your family, keep to your friends. You know, these horrible times will pass, they always do, but when you're living through them, you know, it does feel as though, you know, we're never going to see a lovely day again, but you know, they will come. But whatever you're doing, have a lovely time. It's been lovely having you with you know, with us in these sessions. I hope you've enjoyed them. I hope you've learned something from them, and we will see you next year. I pass.
Thanks, darling. Hopefully you can see my screen. Yeah, I think you can. That's great. Very quickly, just to wrap up, this is where you'll find all the bits and pieces at quantumtrading.com. This is the indicators, Tradestation, TradingView, Ninja, and also MT45. So I think we've covered all 4 platforms this morning. As I say, we're working on NinjaTrader at the moment. We are working on Market Analyzer to get the indicators into Market Analyzer, which is proving quite a job. But once they're in there, we will also be using that platform very much for the stock trading program, which we'll be developing next year as well, which will run alongside the Forex trading program. Just remember, just to highlight, if you've bought one indicator from us in the past, doesn't matter when, in the last 10, 11, 12 years, that's how long we've been going, then you will receive a full credit if you want to upgrade that to something else, if you want to go to a full package, to a bundle, or if you want to go to an education program for Forex. We will always give you a credit for that. Remember that all our indicators are covered by 24/7 support. You get all upgrades free of charge, no questions asked. It's as simple as that. You never pay us any more. It's as simple as that. They are for life. This is Anna's site, annacooling.com, where you'll find all the books up on Amazon, either in Kindle or in paperback, and you can read all the reviews there. We are always humbled by the reviews we read there, which is very nice to see. And you've got all the other links to all the other sites as well. And you've also got a variety of bundled options here as well, in terms of box sets too, of all the various books too. Finally, just to highlight the Quantum Trading Education Program, it is called the Complete Forex Trading Program because, as it said there, includes all the knowledge and tools you need to succeed as a Forex trader. It's as simple as that. It's huge. There are 450 plus lessons. There are something like 250 to 300 hours of video, a deep dive into technical analysis, volume price analysis, as you would expect. You've got all the modules down here, psychology and that, fundamental relational, technical and mechanics of trading, and then a vast array of videos down here as well. And it's all backed up with the VPA room, which is hosted by Anna and myself every day, where students ask questions and we're happy to answer them, and students put up what they're doing in terms of trading, etc., etc. Last year, around about this time, in fact, I think probably a month or so before, in November, I think it was, we launched the funded Forex program. And the reason we did that was twofold. First of all, to give our students the opportunity to put that knowledge to good use, to actually profit from that knowledge. But secondly, also to get a sense of what it's like to trade a much larger account. These accounts start at what we call the evaluation level down the bottom here. You can select, and this is only available to students. We do not open this program to anyone else. It's only available to students on the Forex trading program. You decide where you want to join, 5,000, 10,000 or 15,000. This is our money. This is not your money. You can't lose anything. The only thing that you will pay is an entry ticket down there, as you can see at the bottom. That's it. It's a one-off fee. Once you're in the program, that's it. There's nothing else to lose. It is our money. Of course, there are risk and money management rules as you expect, but you decide where you want to start at 5, 10 or 15. We set a very simple profit target. And once you've achieved that profit target, this is about you finding your consistency and about us learning about you as a consistent Forex trader. Once you've got that, the world is your oyster, because you can move up the levels. Because what we do thereafter from 15,000, if that's your chosen starting point, we multiply by 4. So we give you $60,000 of our money to trade. And in addition to that, you can then start to trade other markets. You've got the indices here, and you've also got gold on the portfolio, what we call the portfolio manager level. And that goes all the way up to $1 and $2 million. You go up in increments of double thereafter. So if you go from 15 to 60, you go to 120,000, 240,000, 480, right the way through to 1 million. You're earning as you go on the portfolio manager level. You earn at 50% of your profit is kicked back to you in a monthly basis. You can choose to draw it or not. It's entirely up to you. And when you get up to the 1 and 2 million, you earn at 60%. So it's significant, I can assure you. There we go. That's the funded program. And as I say, it's only available to our students who are on the program. That's it from me. Just to endorse what Anna was saying, have a great Christmas. Enjoy with your family. Stay safe in these difficult times. It doesn't look like it's going to get any easier. So, you know, it's just enjoy your time with your family. And as I say, we will be back in the new year at some point. One more session to come. We are on again this evening. We're doing the stock trading session at 6 o'clock UK time, which is 1 o'clock Eastern, I believe. So we will see you then. If not, enjoy the rest of the trading day and the rest of the trading year, and wishing you a very happy and prosperous new year into 2022.